Good morning, everybody. Hey, welcome to this Wednesday, the 12th of February. Hope you're doing well. We get inflation number this morning. Heads up, not looking really good. We'll talk about that and more when Dave joins us here in just a few seconds.
His journey there from 105.7 Light FM. Early morning show is here. I'm Morning Dave. We're at 8:42 now, 18 before 9. Advisory services offered through Second Half Financial Partners, LLC, an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments are appropriate for you, please consult with a financial advisor. Second Half Financial Partners, LLC does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation. Yada, 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 yada. I'm not regulated. Phillip Statler is, and the two of us get together every morning in order to talk about money and find out what your finances are. Phillip, you can't say this, but I can. I recommend Dramamine for traders today. How about you?
It is, I'm going to say we've got some rough seas ahead, at least looking at the CPI number this morning.
It does sound that way. We are talking about stocks and bonds and investment materials, and start out the morning, we always do, giving you a set-the-table picture. Yesterday, on balance, was a good day. The blue chips on the Dow were up 0.25%, up 123. Standard & Poor's was up fractionally, only $2. NASDAQ lost, it's $70 down, is almost a meaningless percent day-to-day when we're talking about a price-weighted index with as much heavy tech in it. They were down $70, but none of that means a doggone thing, because at 8:30 this morning, the government put out the Consumer Price Index, the inflation report, and we went up. We went up from a 2.9% annual rate last month to 3%. Then when you get out the stuff that moves up and down, like energy and food and stuff, we went up from 3.1 to 3.2%. That ain't the way we were planning on going, Phillip, and it's not what the market expected either, was it?
Nah, it really wasn't, Dave. We saw a huge drop when the CPI number came out. I'm talking about, about 10 minutes before that number came out, the Dow was up actually $15. It ended up being down substantially after that number came out. And so we were not looking for that. I mean, that's a huge difference, Dave, to be a 0.1% more than what it was last month. That's okay. But to be off 0.2 compared to what was expected, that's not so much. I mean, the expectation was for inflation to go down 3 to 0.3, and for it to go up 0.5%, that's a big swing.
Yeah, when you start looking at a 0.5% bump in one lousy month on the top line inflation figure, it pretty much gives you a slam dunk conclusion that the Fed has not finished the job yet on beating inflation. As a matter of fact, so far the indications are for the last few months, as a matter of fact, it might be fairly said they're failing, because this is like it's like the third increase in a row in the Consumer Price Index. We bottomed out dangerously close to 2% a 3 months ago, and we've been kind of climbing ever since. I mean, this is not the direction we were looking to go, and that implies a whole bunch of things, like, among other things, the Federal Reserve might even now have on the table the notion of a rate increase at one of their next meetings, and that would go over like flatulence in church and the stock markets, I'd imagine.
Well, not just that, but let's talk about the White House, right? That would be a big deal. I think President Trump would be. You might start to see smoke come out of his ears if that happened.
Just a little, I think. He has a tendency to be vociferous as well. We have the Producer Price Index tomorrow. That's either going to confirm or deny the impressions we're getting off of the retail inflation. The other thing that probably didn't help a lot and probably contributed to us starting out flat before the numbers came out was Jerome Powell up in front of the U.S. Senate committees yesterday, and he pretty much reinforced he's being patient on rates. First of two appearances this week. He defended the central bank's budget process and said, no, we're not going to rush this thing. But then he turned around, and one of the things that he said, that, quote, in 10 to 15 years, he said, there could be parts of the country where residents will be unable to get mortgages as insurers pull out of the market. Not only is he concerned about interest rates, but now he's starting to get concerned about homeowners insurance, and his point's well taken. But when the Federal Reserve Chair strays that far off the reservation and starts saying, hey, babe, the economy's got some problems that even I can't touch. I mean, we were a little bit touchy to begin with, and the inflation rate didn't help one tiny little bit this morning.
No, it did not. And if you think that, that would be disastrous for the real estate market. If you think of, Florida coast, you think of Texas coast, Louisiana coast, the fires around California. I mean, those are all areas where you could see more and more insurance companies pull out. And you're right. If you can't get insurance, you can't get a mortgage, and that becomes problematic.
Absolutely. What you just did off the top of your head, you named where about 75% each of those states have residents, so it doesn't help one tiny little bit for the major base of population in Florida and California especially, but along the Gulf Coast of Texas, you got a large portion of their population also living right in those hurricane-sensitive areas. That takes the three most populous states in the country heading toward a syndrome that none of us really want to talk about.
Well, that's right. And so we'll see what happens with that whole situation there in terms of insurance and what has to happen to make that, be a pliable option for people.
Absolutely. We're talking about what happened to the equity markets. What happened to the bond markets are almost exactly the opposite. I got a chart here for the 10-year U.S. Treasury bond yield. It's now up to, holy crud, 4.633%. When the inflation number came out, my chart just went absolutely straight up vertical, and we gained an entire 10 basis points inside of about 5 minutes. And you were telling me that the 30-year bond did about the same thing, right?
Yeah, it did. We're up to 4.83% right now, and that's the number that mortgage rate people look at in terms of pricing their mortgages.
Absolutely. We talk about that reference Federal Reserve rate. That's almost meaningless because that's just the rate that banks pay when they have to borrow money from the Fed when they run short of reserves. None of us ever even pay anything close to that. It's nothing more than an encouragement to raise rates or lower rates. The one that really matters is when we start looking at the 10 and 30-year federal bond yields, because that actually does convert into mortgage rates and credit card rates as well. So, and both of those rates just skyrocketed upward almost as soon as the CPI number came out. So this is not going to be a good day on any of the financial markets, I suspect, except maybe oil, because we got an inventory report in yesterday that said we've got a little bit of a domestic glut of oil supply. And that trend upward you and I were looking at of the price of oil, when we get to the numbers, we actually do have one little tiny tidbit worth of good news this morning.
Well, it's good. We need something good.
Yeah, something good has to happen. Just to throw more gasoline on the fire, we were talking about Bitcoin yesterday. I've got a Bitcoin advocate who is a columnist as well. He predicts that Bitcoin will reach $1 million by the end of 2025 because he thinks fiat currency in all of our nations is going to absolutely hit the commode and go downhill. So Bitcoin's going to become the reference currency for the world, and Bitcoin's going to be worth $1 million by 2025. I'm not moving my IRA.
What was he smoking?
You got to think about it. Like I said, I'm not moving my IRA on that advice. I'll tell you that. Which kind of underscores the fact that read a column, don't assume it's coming straight from the deity to your ears. There's generally a lot of opinion involved there. Bunch of earnings coming in, and one of the household names reported, CVS. Did they actually pull it out and have a good quarter?
Hey, they did have a great quarter, Dave. They beat expectations on both earnings and revenue. They beat substantially, but on the earnings side, they were expected to come in like 93 cents a share. They actually earned $1.19 a share. Revenue was about, I'm going to say, almost not quite $500 million more than expected. But we've got CVS trading up almost 10%, 9.75 right now.
Given the fact that both of the two major drugstore chains have been getting kind of beat up the last couple of quarters, that's good news.
It really is. I mean, that's seeing some things there, and their the last little line there says their full year earnings guidance was in line with what the analysts expected as well.
Cool. That's kind of hitting on all cylinders. Anybody else doing good this morning?
So we had Super Microcomputers. They came out. They cut their full year 2025 revenue forecast, but it doesn't seem to be hurting their stock price this morning. They're up about 10.5%.
My perception is that they pretty much all got beat up in that sector by the DeepSeek release a week or so ago, and we're still recovering from that. Maybe they're just meeting expectations now, huh?
It could be. It could be there as well. So we've got DoorDash. I don't have all the details, but I know that their revenue topped expectations for the fourth quarter, and so they're getting a nice little bump this morning, up almost 5% before we get trading. And DoorDash kind of goes in hand in hand with the restaurants. And so Restaurant Brands International, that's Burger King, Popeyes, those guys, they had a pretty good quarter as well. They beat by about 2 cents a share. Revenue was slightly ahead of expectations. They're trading up a little over 1.5% this morning before we get going. DoorDash also kind of lends to the next one, and that's Lyft. Lyft, however, not having quite the success that we're seeing in the stock price of DoorDash. This morning, we are seeing that they missed expectations this last quarter, especially when it comes to bookings. And so they are trading down significantly this morning, down almost 14.2%.
I don't want to sound like I'm jumping the gun, but I'm kind of getting the feeling that Uber is winning that Lyft versus Uber war. Just watching advertising and the financial reports tend to back it up.
I think they are. I'm seeing some of the credit card companies I use are switching their preferred, who they give you more points for, from Lyft to Uber. And that's just happened this last 3 or 4 months. So I guess I got one more for you. I'm just scrolling through real quick. Zillow reported this morning. They beat on revenue. They provided some weak guidance for this first quarter. And so that has them trading down this morning 8.7%.
Oh, just like my house on Phillip. Resetting the table yesterday was, I call it on balance, a little bit better than flat, but none of that means a darn thing after the 8:30 release from the government. Give me the bad news. What are we looking at 45 minutes before trading begins?
Dave, we are looking at a lot of red ink, and I mean a lot when I say just red ink everywhere. The Dow Jones is down almost 0.9%. That's $394 right now. S&P 500 is down almost 1%, $58. The NASDAQ 100 has passed over that down 1%. They're down almost 1.1%, $229. The big loser today is going to be the Russell 2000 right now, down almost, it's at 1.65% down right now. That's $37. So everything's solid red. Even when we go to the other side, silver down almost 0.5%, gold getting hit pretty hard, down 1.1%. Now, the only good news is oil's trending the same way. It's trending down this morning, almost 1.1%. It's at $72.54 a barrel right now.
I'll take that little bit of good news anyway. Like I said, there was an oil inventory report out yesterday afternoon that said we got a little bit of an oil glut here, and that's kind of negating the Saudi price increase they announced that bumped us back up over 74 for a while. Overseas markets, Asian Rim closed about 6 this morning, so they haven't seen any of our data yet. Just as well, they were on balance up. Hong Kong and mainland Chinese markets were up markedly, by the way. Over in Europe, they did get a look at us, and I've got delayed quotes, but they aren't especially happy. By and large, the average European index down by about 0.5% halfway through their trading day, and by comparison, 20 minutes ago when I set up the page in order to give you the information, they were also up by about 0.5%. So there's been about a 1% swing in Europe just inside the last 20 minutes as well. Getting a retirement plan together so your retirement becomes a plan instead of a dream takes a little bit of expertise. How do I find you to get your expertise in gear on mine?
Dave, that's why I developed the Core Retirement Design to help people design the retirement they always dreamed of. They can give us a call at 863-382-0037, or they can go to our website at statlerfinancial.com to schedule a retirement, core retirement analysis. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk, 7:30 a.m. and 95.3 FM.
Alrighty, and I thank you much. Hope to see you tomorrow here, same time. We'll tell you what actually did shake out today and what's likely to affect your money tomorrow with the wholesale inflation here on Light. Have a good day.
All right, buddy. Talk to you later.
Thank you. It's 105.7 Light FM and Statler Financial Services. Phillip Statler.
Hey, folks, again, I want to thank you for joining us today. Hope your week's going well. I look forward to speaking to you again tomorrow. Take care now. Bye now.